From the morning reading, SPX breaks support as oil rally fails on inventory report and all sectors move lower. All 9 sectors moved lower on Wednesday. XLU, XLP, and XLB were the strongest sectors, while XLY was the weakest sector. Breadth weakened as decliners led advancers 7.62 to 1 on the New York Stock Exchange and 6.7 to 1 on the NASDAQ. Once again, the QQQ and the SPY gap opened higher, rolled over to negative territory after gasoline inventories rose 8.4 million barrels, following a rise of 10.6 million barrels in the prior week. After the inventory report, oil fell from an intraday high of 31.71 to close down 2 cents at 30.56. Once the market turned negative, it gained downward momentum, breaking below Tuesday's low before breaking Monday's horizontal support low. Only 36 stocks in the S&P 500 rose on Wednesday. Bearish trade rules rule until stocks find support. On the NASDAQ, you had only one of the 100 NDX stocks close higher on Wednesday, and 2 NDX stocks are now above their 30-day moving average. S&P 500 headed towards test of the 2015 lows. The daily bars show the S&P 500 losing more than 1% and bearing down on its late September, mid-August intraday lows. That's a very important test. A decisive violation of those lows would signal a much deeper correction. The Russell 2000 small cap index has already fallen more than a 2-year low and is now in bear market territory with a loss of more than 20%. That's not an encouraging sign for the large cap SPX. And this author continues to believe that the current market condition is the riskiest since the bull market started in 2009. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 7:03 a.m. Central Time, and I am recording this in preparation for the market day of January the 14th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. There's quite a bit of action and moving around last night, and indeed, when we take a look at the time of this cut, we're up slightly, but this has been definitely moving around, so you'll have to recheck at the market open. S&P futures are up over 4 points, about 1/4%. Russell's up just above scratch. NASDAQ's also up just above scratch. Dow is up about 1/4%. Crude oil is up sharply, about 1.28%, but we've seen in recent days that sometimes it will gap up and then lose it all during the course of the day. So this has definitely been a very volatile market. The euro is essentially scratch. Bonds are down about 1/4%. Gold is essentially scratch. And overseas action, quite mixed, going in different directions. China up about 2%. Hong Kong down over 0.5%. Japan down over 2.6%. Germany also down sharply 2.5%, as is the United Kingdom down sharply about 1.7%. Given that we're slightly up about 1/4% and the DAX is down about 2.5%, I would expect that something will give between those two markets. In terms of the macroeconomic reports for today in the U.S., we had the weekly version of the unemployment claims and then FOMC member Bullard speaking. We have import prices and then a couple other yellow flag, but depending on your markets, this could be important. Natural gas storage inventories and also the 30-year bond auction. And the Friday, there's a full slate for the U.S., starting with core retail sales, PPI retail sales, core PPI Empire State Manufacturing. You also have FOMC member Dudley speaking, and then that's then followed by capacity utilization, industrial production, University of Michigan consumer sentiment, and the inflation expectation. So a full slate of economic reports, both before the market and after the market, to finish out the week. terms of volatility, we definitely have seen a lot more volatility of late. Short-term VIX is now up over 25 again, 25.57. Skew, again, very, very elevated. And we've seen these probabilities play out. Indeed, yesterday we had 2 standard deviation moves put in by all 4 indices. That followed a period of relative quiet, but certainly we've retained this relatively high skew rating, and we continue to see these really big pop days. In terms of the IV percentiles, they're kind of middle of the range for the year, but certainly high compared to recent activity, with 48 on the S&P, 48 on the Russell, 46 on the NASDAQ, and 50 on the Dow. In terms of the charts, let's take a quick look at that. And give me just a second here, resize this a little bit. I should have done this before the opening up the video, but it won't take but a second. There we go. That'll make it easier for you to see. So look at this action here. I mean, that's about as ugly as it gets. And while we did have a little bit of a reversal action, which did confirm, as we suspected with our thesis A, that this would be just a bull flag. And that bull flag, if you had taken a bull flag entry right about here, would have absolutely been profitable even on the very first day of that trade to the downside. You notice here, in terms of pot odds, though, that you're starting to get into a place where, while the downside is still attractive, we could find a very important area of support, first around 1871 and then 1867. Those are just a handful of points. Anywhere in that area, you could see the institutions start to accumulate and bullish action take over. This is going to be a make or break area. If you fall through that area, we can get quite ugly. And indeed, the next significant would be this October of, I think this is 14, October of 14, yes, October of 14, swing low. This was on a big wick, and you see that is down here about 1820. So just a few points, easily within range of 1 day's price action to get to this very, very important support area. If that doesn't hold, the next line in the sand is about another 50 points below that. We could literally be here in 1 or 2 days in normal price movement ranges if that were to have breakdown and momentum start to accelerate. If we get down to the second level and that doesn't hold, then it gets really, really quite ugly. There's, you know, extensions and exhaustion levels, and perhaps you could say 1736 and some of these other areas, but this really gets to be quite stretched in terms of, you know, making much of a case of significant support beyond this level. So it would be much trickier to be able to determine where, you know, significant support could be coming into play, and we'd have to watch for price action to simply exhaust and flush before starting to reverse. In terms of this action right now, that's your S&P, just very little room to go. But while the NASDAQ and the Dow are very similar, the Russell is significantly weaker. And you notice here a complete breakdown. We mentioned in the morning reading, the Russell is some 22% from the highs. One of the things I took note of is that right now, if you went 30 days out on the Russell at a 10 delta and sold a vertical, you would go out to 890. I mean, that seems like a very, very long way away, and yet at the same time, that tells you just how much of a breakdown we have had. That would represent something in the whereabouts of a 32% drop from the recent, you know, this is not that long ago. You know, here we are, I guess this is June, but from these June highs, that would be some 32% down to that 10 delta area at just 30 days out. So This is starting to look kind of attractive to start to want to put some stuff below. But while you still have this deep falling action, that's not the time yet. So be patient, Grasshopper, and wait until you see those reversal signs and something more significant of support coming in, and then put on that stuff. You have to be quick because volatility get crushed in a hurry, but that premium is very juicy and can be placed very, very far away, even on a 30-day time frame right now. So we want to continue to watch this because opportunities are starting to set up. In terms of the SPX, this one itself, you go out to a 10 delta, we're talking 1700, and so this would be down here around here. That's just 30 days out, 10 delta. That would represent about a 20% drop or bear market territory for the SPX. Now, I should say that the SPX, the NASDAQ, and the Dow, they're all in correction territory now. And this is quite remarkable given that we went some 1,000 days without a correction before the August correction, and here we are 4.5 months later, and we're in another correction. So do not take this market lightly. I saw an article by IBD yesterday that mentioned that for the typical retail trader trying to set up positions in a bear market is not very easily achieved and set up for success. Far better to set that bottom and wait for that confirmation pattern, so you don't nail and you don't even try to nail the bottom. And indeed, that confirmation pattern usually takes several days off the bottom, and you'll miss that. But far better to miss a couple, 3-4% points off the bottom when you are in correction and bear market territories like we are currently talking about these broad market indices, than it is to come in too early and then find that the market drops another 10 or even 20% from where we are now. So do not catch that falling knife. If you are a novice trader, stand aside and wait for those confirmation patterns to form before you start to scale into positions. Same time, certainly we start to get our watch list together and we start to watch where even like an option income strategies and other swing opportunities, there might be opportunities, and there definitely will be opportunities in on these charts in the coming days to weeks. It might even be weeks to months. We don't know yet. But for example, if you're trying to build out a core portfolio position, this is a great opportunity. You just have to be patient to make sure that you get that opportunity and you take advantage of it in the right way. In terms of the daily report, it's about as ugly as it gets, and perhaps as ugly as it has been since I started putting this report together many, many months ago. Phase 5, the break of horizontal diagonal support, we're waiting for that to roll up. And one of the first things we'll look for, of course, is things like MACD divergences, but also that we get a break of diagonal. And let's put this back on the daily. So if you draw a line on the diagonal, and as fast as this is falling, this is not easy to do. But if you draw a line on the diagonal, and then you get a couple things. You look for a close above the prior day high, and you look for a break of that diagonal resistance and a close and confirmation above that. Those are the kinds of things that we look at to see a potential for the start of a reversal pattern and perhaps a departure from this phase 5. In terms of other signals from the portfolio investor posture, again, no changes here. Market and correction, accumulation distribution in the S&P, and E, the NASDAQ, and E, as ugly as it gets. GMI index, a 0 out of 6. Full out sell signal. That author remains 100% in cash. Decision point scoreboard, we went over this yesterday. A number of breakdowns here and just about stacked. We waited so long to see this stack form, and we're about to see this stack form with the short term, intermediate term, and long term all telling us bearish. Intermediate term market posture, very bearish with the bearish sentiment line. Position sizing opinions, very, very defensive at 0% and 50%. Intermediate term market posture, about as ugly as it gets. You are severely bearish on all four with no bullish clusters. Hedge warning status, a full out level 3, which is our crash warning. This is not a prediction of a big drop or how far it might go, but it is a recognition that the risk conditions are currently present, that such things are quite probable. And we have to respect that as we put together and manage our portfolios and swing trades and option income trades and other things. So hedge warning status, full out, crash warning potential. In terms of the individual metrics, again, SC of red here, market in decline, sharp increase warning, both have fired. VIX futures well up over bull market territory, well up over 18. You do also have our distribution day count is in kind of put aside because we're in market and correction. We did get a volatility ratio warning again yesterday. We had one a few trading sessions ago. We got a close below, which would mark the reversal, but in this case, that reversal turned out to be just as we suspected, a bear flag, and then confirmed again down to the downside, giving us another volatility ratio warning. So big spike here in volatility between that short and intermediate term ratio. VIX phase is increasing. That skews, we talked about earlier, about a 7-fold probability of normal that will have a 2 standard deviation move in the next 30 days. So this is very, very high probabilities. 14 may not seem a lot, but normal is about 2%. So you have a much higher probability of having really big moves. Current week out expected move is running about a 60, and I suspect that that could grow very quickly if we were to continue to break through these key areas of support. It's hard to believe that we'll go straight through those areas of support. 1870 area is likely will prove to be at least a bounce, so be aware of that. In terms of the New York Stock Exchange, new highs, new lows, again, I think this is a third out of 4 trading sessions. We're well up over 1,000. The key intermarket risk aversion indicators, all 5 of those are flagging as risk off. That's more warning. And then in terms of the fear and greed index, you're currently at a 14. We're now down in extreme fear area for more than one session. In terms of special opinions, no changes here. All 3 option income strategies, cover calls, and put selling special opinions are basically outside the acceptable window to initiate new position for novice traders. And as the IBD article mentioned, it is best for retail traders, not just novice traders, to stand aside, stay in cash or like positions until we get those confirmation patterns off the bottom. This is the kind of market where it's you could lose not just 2 or 3%, but you could lose 10 or 20% of your trading capital in a very quick period of time. And capital lost takes a lot of work to get that back to even. If you lose 10%, you have to make over 20% return to be able to get back to even. So the best thing you can do in these kinds of market conditions, and this may be the most severe risky conditions that we have had since the beginning of the bull market in the spring of 2009. The best thing you can do is to stay very defensive, very conservative, and perhaps even largely in cash, much like our GMI. And I mentioned this one right here, the GMI index, that author is 100% in cash. That is a person that is sleeping very well at night right now, is not worried about catching the dead bottom, but instead is concerned about not losing 10 or 20% of his portfolio and is willing to give up a few percent off the bottom to be able to retain that capital. So very important metric there. That's enough for today. As always, if you find that what you're getting from here is helpful to your trading, we certainly appreciate those retweets, to your Twitter followers, to your StockTwit followers, those likes on YouTube. Remember, you can subscribe to the YouTube channel, and that'll give you notice when content is posted. Some special opportunities. I'm just flipping through here. You can hit the pause button. We've gone long enough today. If you need more time, just go to these hyperlinks. You'll get more details, more opportunities here. Disclaimers, as always, hit the pause button if you need more time to review. And of course, you've got the hyperlink at the bottom for the full disclaimers of all the disclosures. We'll see you back here tomorrow morning before the market opens with the market preview by Falcon Global. Good trading.